Hello everyone. So in this session we will learn about admission of a new partner in the partnership firm. Now, why do we need a new partner in the partnership firm? The reasons could be many. There might be requirement of additional capital that is required to be invested in the firm, else the old partners need someone to management. Then there the goodwill of the new partner, because of the goodwill of the new partner they are admitting that new partner, or there might be some special qualification of the new partner, so because of which he needs to be admitted in the partnership firm. Now, when the new partner is admitted in the partnership firm, it is like a new firm, since the old partners will have to share some proportion of their profits to the new partner. It is like a new firm. Now let us see one example here. Say this is A and B. Now A and B have come together and formed a firm, partnership firm. Now they are running the business. Now after 5 years, A and B are planning to admit C in the partnership firm. Now, before admitting C, A and B have done the business for the period of 5 years. Now, this firm, before admitting the C, as on the date, say today they are planning to admit C. So, as on date, this firm has some assets, some liabilities, some reserves. Okay, now this assets, liabilities and reserves belong to A and B. Because C is a new partner, he will be admitted today to the firm. So this assets, liabilities, reserves and profit is a result of the business done by A and B in last 5 years. So this assets and liabilities need to be revalued. See, there is a possibility that some assets, liabilities might be undervalued or overvalued. So, before C is admitted into a partnership firm, this assets needs to be revalued, because say if this asset is overvalued or undervalued and there is a loss or profit or on revaluation of the assets and liabilities. Now, this assets and liabilities is a result of the business that was carried by A and B. Now this profit and loss, because of the revaluation of the asset, will not be or need not be borne by C, because he is a new partner. Even if there is loss, it will not be borne by C. Even if there is a profit, it has to be distributed between A and B and not C. So this assets need to be revalued. That is, this needs to be revalued at their realistic value, and then accordingly whatever is the profit and loss on the revaluation of the asset need to be borne by A and B, or if there is a profit, it needs to be distributed between A and B. Because C was not there in the partnership firms for last 5 years, A and B were carrying on the business. So till date, they whatever assets and liabilities they have, that needs to be revalued and the profit and loss needs to be distributed between A and B. Now, reserves. Now, this reserves is nothing but accumulated profit. Now, this accumulated profit or reserves is a result of a business that is carried on by A and B for last 5 years. So, this reserve need to be distributed between A and B in their old profit sharing ratio. Then, now there might be some goodwill. of the firm. Now this goodwill of the firm needs to be valued, and since C is admitted as a partner, C will be given some profit sharing, and that profit sharing will be sacrificed by A or B or both of them. So C has to compensate his share of profit, for the goodwill. Say the goodwill of the firm is 1,20,000 and C's share is 1/6. So C has to compensate 1/6 of 1,20,000. So that comes to 20,000. So this 20,000 needs to be shared by A and B in their sacrifice ratio. Sacrifice ratio is their new profit sharing ratio minus old profit sharing ratio. If it is negative, then A and B have sacrificed to C. So that 20,000 needs to be shared by A and B in their sacrificing ratio. Now let us see what are the steps that are required to be taken before admission of a new partner. We have already seen the example. Now let us summarize the steps. Now step 1. All the assets and liabilities need to be revalued. Now, all the assets and the liabilities of A and B or of the old firm, we'll call it as old firm, need to be revalued. Similarly, there might be some liabilities or assets which are not recognized in the books, except for the goodwill, need to be recognized in the books of accounts. Say if there is some unrecorded sale or some unrecorded expense, that needs to be recorded in the books of account. Now, when the assets and liabilities are revalued, what we do is there are two methods. Let us see what is the first method. We need to prepare one revaluation account or profit and loss adjustment account. Now, what we do is whenever there is an increase in the value of the asset, then asset account is debited and revaluation account is credited. Whenever there is a decrease in the value of the asset, then revaluation account is debited and asset account is credited. Whenever there is an increase in the liability, then revaluation account is debited and liability account is credited. If there is a decrease in the liability, your liability account is debited and revaluation account is credited. So now if we see on the credit side of the revaluation account, there is either increase in the asset or decrease in the liability, whereas on the debit side of the revaluation account, there will be decrease in the asset or increase in the liability. So after revaluing all the asset, and we also need to recognize the liabilities or the assets which were not recognized earlier. So after revaluation of all this asset, there will be either revaluation profit or revaluation loss. Now this revaluation profit or loss needs to be distributed between old partners in their old profit sharing ratio. Since the new partner is not responsible for revaluation loss, at the same time he is not eligible to earn any profit on the revaluation, this revaluation profit or revaluation loss needs to be distributed between the old partners in their old profit sharing ratio, that is their profit sharing ratio before admission of a new partner. Now in this method, this is a method 1. In this method, what we can see is we need to prepare a separate revaluation account or profit and loss adjustment account, and all assets are revalued. That is, when we prepare a balance sheet, all assets will be reflected at the revalued amount or revalued figure. Now, some partners or all the partners may decide that we will not actually revalue the assets in the books of account, but whatever is the revaluation profit or loss will be borne by the old partners, or revaluation profit will be distributed between the old partners. So there is one more method. Let us see. When assets and liabilities are not to be shown at the revalued amount in the balance sheet, but at the same time the revaluation or profit or loss needs to be distributed to the old partners, what we do is we need to prepare memorandum revaluation account. Now this memorandum revaluation account is, memorandum is outside the books, outside the books of accounts. So here we prepare a memorandum revaluation account. Now memorandum revaluation account, the entries in the memorandum revaluation account will be similar to your normal revaluation account. That is, on the credit side of memorandum revaluation account, if there is an increase in the asset or decrease in the liability, it will be recorded on the credit side of the memorandum revaluation account. If there is a decrease in the asset or increase in the liability, that will be recorded on the debit side of memorandum revaluation account. The entries for revaluation will be same, but here in the whenever we prepared a revaluation account or profit and loss adjustment account, the second effect was either debited or credited to asset account or a liability account. Now here we won't credit or debit the asset account or a liability account. Only for purpose of calculating profit and loss on the revaluation, we will be posting this entries in the memorandum revaluation account. That is, we will be doing this entry outside the books of accounts, and the asset and liability we will not be credited or debited. Then now whatever is a profit or loss because of revaluation, see if there is a profit on the revaluation, now this profit will be distributed by all the partners, that is their old partners, in old profit sharing ratio. Now see, this is a memorandum revaluation account. Now we have passed the entry only for the sharing of the profit from this memorandum revaluation account. Now this memorandum revaluation account is outside the books. Now we have not passed any entry for revaluation of assets and liabilities in the books. So now what will happen because of this? The entry here, say in the case of profit, the entry will be memorandum revaluation account debit to capital account of the partners, right? So now if we see, this memorandum revaluation account is not in the books. Now capital account of the partner is credited. Now only one effect of this profit has been given to capital account. Now there is no effect of this profit in the asset and liabilities as it was there in the revaluation account or profit and loss adjustment account. So now what is done is, again this entries, all these entries, say there was a profit earlier, say profit was 1 lakh. Now we need to reverse this entry of the profit. Now this profit of 1 lakh will become loss of 1 lakh. Now this reversal of the entry will be shared, this loss of 1 lakh, this reversal of profit of 1 lakh will be shared by all the partners, including new partner, in new profit sharing ratio. So the entry for this will be, we will be debiting the capital account of all the partners to memorandum revaluation account, and this will be in new profit sharing ratio, whereas this distribution of the profit was in old profit sharing ratio. So this is a new additional step which we need to take here since we are preparing a memorandum revaluation account. Now what has happened here is, see, if there is a profit, what has happened is this profit was shared to all the old partners in their old profit sharing ratio, and at the same time this profit was shared, and then at the same time this profit reversal entry for the profit was debited to the capital account in new PSR. So now what has happened is, indirectly what we have done is, we have distributed this profit in the sacrifice ratio of the partners. Okay, we have credited it in old profit sharing ratio and then debited the capital account in new profit sharing ratio. So in short, we have distributed this in the sacrifice ratio, and now for the new partner there was no credit entry. He has directly been debited, his capital account is directly debited by new PSR. So it is like the new partner is compensating to the old partners in the sacrifice ratio. So it is similar to the treatment of the goodwill that we did earlier. But here we are doing it indirectly. Now say if there was a loss on the revaluation. Again, if there was a loss on the revaluation, that loss will be distributed to old partners in their old profit sharing ratio by passing the entry as capital account debit to memorandum revaluation account, and then this loss will be reversed. That is, if there was a loss of 1,20,000, it will be reversed. So it will become like a profit. So your memorandum revaluation account will be debited. So the loss reversal entry will be memorandum revaluation account to capital account in new profit sharing ratio. So this is one more method wherein we do not change the value of assets and liabilities, but at the same time the revaluation profit and loss of the asset and liability is distributed among the partners. So this was about step 1, that is revaluing your assets and liability. Now step 2. Now what is a step 2? Step 2 is reserves. All the reserves of the partners which were earned previously needs to be distributed to old partners in old profit sharing ratio. That is a step 2. Then step 3 is a goodwill. So goodwill, now new partner will bring his share of goodwill. Say if the total value of the goodwill of the firm is 1,20,000 and the new partner's share is 1/6, then 1/6 of 1,20,000, that is 20,000, will be brought in by the new partner. Now the share of the goodwill which is brought in by the new partner will be shared among old partners in sacrifice ratio. So these are the three steps which we need to do before admission of the new partner, that is revaluing assets and liabilities and transferring the profit and loss of revaluation to the partner's account, that is old partner's account. Then if we are preparing a memorandum revaluation account, then we need to transfer the profit and loss to the old partners in old profit sharing ratio. Then we need to reverse that entry in the new profit sharing ratio. Now, step 2 will be reserves. All the accumulated reserves and profits of the previous years needs to be distributed to the old partners in their old profit sharing ratio. And then the step 3 is goodwill. Now, new partner will be bringing his share of the goodwill. Now, that share of the goodwill needs to be distributed between the old partners in their sacrifice ratio. That is the share of the profit that they have sacrificed for the new partner. Now these are all the steps that we need to do before admission of a new partner.